Welcome everybody to the Great Property Meet YouTube channel, where today I have the fantastic, phenomenal Akhil Mair from Mortgage Broker with us. We're going to be talking commercial mortgages. Akhil, would you like to introduce yourself and tell everybody your background, experience, and why we should be talking to you?
Sure. Thank you, Andrew. Thanks for having me on. Well, everyone, my name's Akhil from our Mortgage Broker. I've been in property and in particular finance since the age of 20. I joined HBOS and in particular Halifax initially in the year 2002, did numerous roles within the retail network. And then when we had the merger with Lloyds Banking Group in sort of 2008, 2009, I was then a credit analyst with the financial institutions. So I was a credit analyst, particularly looking after the Southern European banks at that time. So I had a 10-year span with HBOS in Lloyds Banking Group, and then I had other various roles with other high street banks over a 3-year period. During my time in retail banking, I've also invested in property as well. So I've always loved finance, but I've always invested in property. Straightforward, vanilla buy-to-lets, that's always been my bag. I'm comfortable with that. It's more of a than an investment trying to grow my portfolio. It's more of a pension pot for myself, my wife, and my kids. As I've always loved property and I've always been in finance, I wanted to marry that together and become a mortgage broker because I really enjoy finance and property. And here we are today. So I've formed our company called Our Mortgage Broker in 2019. We've got various disciplinaries. So we offer mortgages for first-time buyers, portfolio landlords, all the way up to commercial mortgages as well. So we're sort of store.
I was going to say, so we met shortly after you started, or around about the time you started at the Baker Street Property Meet in London.
Correct, yeah.
Would that be about right?
Yeah, certainly right, Andrew.
Fantastic. And you've got a whole wealth of experience there to be drawn upon from being inside a lending institution and being on the outside as an advisor and being an investor. So that's a real attribute and strength for us to draw upon to help your clients.
Yeah, no, I totally agree. Thank you for that. No, I totally agree. I think it's nice to have, when I speak to my clients, I understand how they want to invest in property and I can portray that and give them my experiences over time. So I've seen pre-recession investing and I've seen post-recession investing as well. So I can add that experience and it's part of the service at Our Mortgage Broker we give our clients is work with our clients and ultimately let them know that we actually work for the clients and not for the banks themselves. So it's hand holding, giving them the right, keeping the communication channels open and doing the best thing by the client ultimately.
Brilliant. Well, that's the right attitude to have and that will be a winning formula for your business as well, taking it forwards. Absolutely. I mean, we're here today to talk about commercial property, which is one of my favourite subjects. And I get asked lots of questions. I want to bust a myth or have it confirmed as a fact. So, you know, fact or myth, commercial mortgages, they require large deposits and you can't borrow 100% of the purchase price. How would you approach that subject?
It's a great question, Andrew, and thank you for putting me on the spot. I think it's not widely known, but in short, you can get 100% commercial mortgage. It is widely available. There are some disclaimers that lenders put in. So with commercial mortgages, yes, typically it's advertised as you need a typical deposit between 25 and 40% of the purchase price. However, if you've got additional security to put into the mix, you can then stretch the loan to value to say 100% of the borrowing of the new purchase. Or alternatively, if you manage to snap up a great commercial property from auction or through a probate sale below market value, you could potentially get an uplift in the value at market value and get the increase in the added value and benefit from 100% borrowing at the open market value rather than the purchase price because you found yourself a great deal. You might have bought it, as I said, from auction or through probate and so on. So there are options out there. There are lenders that can support up to 100% borrowing for commercial mortgages, but there's a few more questions that will be asked with regards to the property itself, the plans for the property. So for example, if you found a property, say for 200,000 and you've managed to secure it at 200, but then there's potential uplift because you're going to do something through permitted developments, or the open market value warrants a new valuation of say 300,000 because of the neighboring properties, you will benefit from that. But it's working with the right lenders, that's the key, and the surveyors as well. So we've got to keep the communication and the actual business plan, make everyone aware within the same circle.
Yeah, no, perfect. I mean, that is almost how I look at the subject. I'm not a broker, but that's how I approach it. And something else that I've done before is I've lined up a commercial tenant to go in property, and my purchase price and the valuation based upon the covenant that the tenant gives can also bridge that gap by the uplifting by moving in a quality tenant.
Yeah.
So that sort of leads us on then through to criteria. Yeah. How does a lender assess a property? I mean, you've sort of touched on it in a few points there, but how in your experience does a lender assess and value a commercial property?
Okay, so when it comes to valuing a commercial property, there's sort of three parts to that. And I always say to the client, there's three core parts that I need from the client before I structure and share that finance proposal to the lender. The three parts are, one is about the property itself. So what does a property look like? Does it have the additional benefit of residential? Because usually what happens is the residential element pays you more annual income than potentially the commercial will. And then the lender will appreciate, then give you more of a blended, more of a reduction in the interest rate. So property type, property location, that's the key part from the property perspective. The second part is who the tenant is, who is the covenant going into that property tomorrow. So is it a blue chip company or a corporate that we're all well aware of? Is it a Costa? Is it a KFC? Is it a Pizza Hut? And so on. So they will all ask the question around who the tenant is. What's their balance sheet look like? How strong is the lease? Is it an FRI lease? Who are the, as I said, who are the tenants? What their balance sheet looks like? And ultimately, how confident they are in that particular covenant that they're going to stay there for that period of time and beyond. So they will deep dive into who the tenant is. The last thing I would say is about the landlord's experience. So that's probably the third part of the puzzle, is the landlord's experience. Now, has the landlord got commercial experience? Does he hold other commercial investments? And what's his track record in investing in commercial property as an investor? That's the third phase. And whether you're buying a commercial to invest in, or you're going to buy a commercial as an owner occupier to trade for yourself, those three core principles still remain the same. So property location, tenant type of business it is, and the landlord's experience itself. They're your three sides of it. With regards to your valuation, how you value a property, some lenders will value it based on the yield. They'll then contra that to who the tenant is and the strength of the lease agreement. Some will go off a bricks and mortar valuation, or you may get a blended of both. As a landlord, as an investor, as you are, Andrew, you probably look for a yielding valuation because that'll give you the uplift on the valuation, and that will then determine a larger loan to value, hopefully. So I'll always ask the client, are you looking for a yielding valuation? Are you looking for a bricks and mortar valuation? As investors, everyone wants a commercial valuation, i.e. a valuation that, a rental valuation that warrants a commercial valuation. Now, there are different variants to that, and it would be subject to the property type, the tenant, and the landlord's experience. But I always put the disclaimer, it is subject to the valuer's comments, and the lender will always lean to the surveyor to make that judgment. But what we do as brokers is we work with the client, we work with the lender, we work with the surveyor. So we would, for example, put together a deal proposal or a valuation proposal, and to do analysis on the market, the current market within the surrounding foot flow, the surrounding high street, to give them more of an indication. So we don't want to teach the surveyor their job or tell them how to do it or what to do, but we want to give them enough to say that the landlord's got the experience, the landlord knows what he's doing, he knows what he's looking for, and this is his business plan. So I think we've done this on numerous occasions with our clients and other lenders and surveyors, and they really appreciated that we've put together a small sales deck, if you like, and shared that with them. A lot of our clients ask the question, should I go to the site at the time of the valuation? Now, I would always say it's 50-50 whether you should go or you shouldn't go, but I always lean towards going to the valuation. Some of your viewers may say, oh, I don't think that's the right thing to do, but there's no harm in you turning up to the valuation, showing who you are, because there's only so much a piece of paper can tell who the landlord is. But if you turn up there, you look well, you dress well, you speak well, you know what you're talking about, it just gives that surveyor that extra confidence in who they're lending to ultimately. So I think that's a good thing to take into account.
No, I agree with you. I go along to valuations, and the approach I take, it's to show them respect and show that you are the second smartest man in that room when it comes to valuations, because they've gone to university, they've studied 4 years, they're there to get 2 years in the trenches in the field before they get qualified as a surveyor, go out and do the valuations.
Yeah.
So it's always worth showing the respect to them. Within that sort of criterion, you touched on interest. And people often go, oh, commercial's expensive. And they don't necessarily understand the terms that are used, because often commercial is priced against LIBOR, the London Interbank Offer Rate, opposed to bank base rate. Can you explain that in layman's terms for the audience, please?
Sure. So those guys that invest in residential mortgages, those mortgages are linked to the Bank of England base rate, and they're either in addition to the banker base rate or they're a tracker rate which tracks the Bank of England base rate. So every bank then concentrates on the Bank of England base rate, which is currently 0.1. Whereas with commercial property, commercial lenders track, as you said, Andrew, the LIBOR, which is the London interbank offered rate. Now, what the LIBOR is it's similar to the Bank of England base rate. However, that rate can get changed every day of the week. So what happens is every morning, a number of banks get together and they take into account how the economic is worldwide and the bearing it has on property and how they borrow to one another overnight. And they then dictate what the rate of interest is for LIBOR for that coming morning. They usually do follow the US 3-month swap. That's usually an indication of what the LIBOR is. Every bank has their own way of setting their own LIBOR. So you may have a bank like Interbay, for example, having one rate as a LIBOR. You might have Shawbrook offering another rate, or you might have Aldermore offering another rate. So they might be a bit dissimilar, but that means they are all tracking LIBOR and they do talk to one another, but they don't all track the same exact rate. They don't all mark the same rate. However, LIBOR is going to be changed going forward in the next year or so. It's now being replaced by something called SONIA.
Okay.
Don't know too much about it, but SONIA will be replacing LIBOR, and it's more of a definitive of what commercial lenders and banks, how they should negotiate this rate going forward. So SONIA is more of a deterrent to banks trying to make a quick buck overnight. So it's something that's coming forward. The short variation is called SONIA, but it stands for something. So forgive me, I don't know what exactly it stands for, but it's something like, it'll be overnight something, that's for sure.
Yeah, no, that's perfect. And that's a really great tip to look forward to as well. I mean, having worked in banking myself, so that each lender will have a slightly different take. Their in-house economist will apply different risk factors to different things within the economy, and the LIBOR rate will be tweaked around what type of business they want to write on that particular day, week, or month as well. So you also sort of mentioned, when we were talking about criterion, covenants. What sort of typical covenants do you see that lenders like?
Okay, so it varies from lender to lender. You've got the high street lenders will probably and do like vanilla tenants who they actually know. So high street brands, high street names that we all know, or we shop in on a daily basis, or we visit for a coffee and so on. as I said, High Street would want those sort of brands. However, the challenger banks that have come into this market are a bit more, have got more of a flexible approach. They're more keen to understand who the landlord is, who their balance, what their balance sheet looks like, and their experience. They will want to look into the lease as well, which is key. The strength of the lease, whether it's got any
break clauses or,
which is fair enough. But again, they might deep dive into actually the tenant's background as well. So the tenant's background, they will dive into, and particularly their business accounts. Because ultimately, when the challenger bank or any bank wants to lend on a commercial premises and give you a term loan, they're going to want to see the strength of those balance sheets, because they're going to want to know what is that business earning per annum and how strong is that balance sheet to repay the mortgage payments, the commercial mortgage payments on a monthly basis, let alone make a profit to take home with them. So commercial lenders usually stress it, like all banks do, whether you're buying a buy-to-let, there is a stress rate they apply. It is anything between 125%, and I've seen up to 175%. So it is quite varied. It's quite a large variance. However, it depends bank to bank, on lender to lender, and they've got their own deals and proposals. And the other variable is the loan to value. That usually dictates what the stress levels are. So obviously the higher you want to borrow, the stress levels may be a little more higher, but it's there to secure and safeguard the landlord as an investor, to ensure that they're getting the right tenant in. They've got a strong balance sheet behind them, the tenant has, and ultimately they're going to stay there for the length of the lease. With regards to the interest rates, again, there's very much a variance and quite a bigger gap now. I'm seeing a wider gap from the high street to the challenger banks. And the reasons for that is the challenger banks are still offering great loan to values. So those landlords that are looking for 65, 70, 75% loan to value, you probably have to target your lender appetite to those challenger banks, because they're in the market for those sort of businesses and those loan to value rates. However, the high street banks are a bit more squeezed. They won't go as high as that. However, they won't go as high, but then you'll get the real vanilla low rates. So you might get 3 over base, for example, 3% over LIBOR. Or with the challenger banks, they might stretch it to 65, 75% loan to value, but you may need to pay 4.5%, 5% over LIBOR. So it is very much subjective. As you said earlier, it's to do with the property, landlord's experience, who the tenant is, and ultimately what the loan to value looks like.
Are there any quick tips then, just to finally wrap up, that you would sort of give to somebody who has got a prospective tenant approach them for their building, as to how they could assess before getting valuers and banks involved, to decide would they make a good tenant for this lending perspective? If you went to a mortgage and said, I'd like to finance this building with this tenant, is there anything you would do on them as the investor?
Yeah, as a prerequisite, I would always ask the client or the investor to ask the tenant about their profile. So what I'll do is I'll do a tenant profile, as you would when you're getting a buy-to-let tenant in. Do a tenant profile on the commercial covenant. Ask them of their experience. Ask them for 3 years business accounts. Ask them, have they got other trading businesses? Are they a franchise? Have they got other units elsewhere within the close proximity? If they have, go and visit those premises and see how they're trading their businesses. Look at the shop fittings. Are they professional? Are they professionals? Are they running a greengrocers? But have they got the right look about it? Have they got the presence? So tenant profiling is key. And I think you've got to investigate who that tenant is, look at their experiences, and look at their business accounts. I think they're going to be your 2 fundamentals that you need to be looking at for sure.
Perfect. I think a very smart way of doing it, because at the end of the day, you want to make sure you get the right tenant in. And I look at it from how many hours a day do they have to work to pay the rent,
Yes.
as another variable. So
Akhil,
it's been great to have you on, and great to have you sharing all of this wisdom on commercial mortgages. What we'll do, we'll drop a web link down here to ourmortgagebroker.co.uk so that people can get in touch with you. And if people have questions, they can fire them off on the YouTube or on the social media posts and tag you in. We'll put your social media there so that people can connect with you as well. thank you very much for your time today and for sharing so much wisdom as well and experience.
Thank you. It's my pleasure. Thank you, Andrew, for having me.
Welcome.